Howdy there, folks. We got a 2-for-1 here tonight. 2 videos to react to. First one up here is from Mohammed El-Alerian that I think is very important. I want to hear what he has to say around the Fed. What is his outlook for kind of what the Fed's up to here? Second video I want to react to is Fed rate cut in 2023 is unlikely. And a lot of folks are thinking like the Fed's about done now at this point in time, or maybe they're going to start cutting soon, something like that. And I think maybe people are jumping a little bit fast in this whole situation. And I think a lot of people think inflation's now done, and they think that the Fed's about to cut rates or something like that, right? And you might just be a little ahead on that whole situation, okay? And so I want to react to both these videos because I think it's very important that all of us as investors don't get too excited because you see inflation come down from, let's say, 9% to 6%. And it is very important to understand what the Fed's still up to in this whole situation and not get too excited nonetheless. So hope you guys enjoyed today's video. As always, by the way, thanks for everybody that was giving me feedback on the main channel video here today in regards to new camera. Got obviously a lot of folks who definitely thought it was better quality than my old camera. So I do appreciate that. And also appreciate everybody subscribe to the channel. Gosh, what are we at now? I think we're at 22,000 plus subscribers on this channel. Absolutely incredible. So this channel is growing massively day after day after day. So I appreciate everybody joining me. And also, you want to know what else is growing fast? We have one of the fastest growing Patreons in the world right now. This baby is growing like crazy. And nonetheless, if you haven't checked that out yet, what the heck are you doing? You got to join us in there. That will be pinned comment down there. And you get to see the moves I make every single week in the new Patreon portfolio, which, by the way, is off to a ridiculous start. We just started this account literally this month, and we're already up 9%. 7 of the 9 positions are positive. And I'm looking forward to everybody being able to see from the ground up exactly how I build a portfolio, $150 every single week. And I mean, as somebody that's been in the market a long time, it's fun to build a brand new portfolio like this and show the world exactly all the moves I'm making every single week. And by the way, I just made several moves on Friday. So if you want to see those, check out the pinned comment down there. Join us in there. It is, I don't think there's anywhere else you could join. That's a more cool place than right there. Okay, let's jump into this.
25 versus 50 debate. Are we ready for that downshift all over again?
It's a really tricky one, John. There's good arguments for both 25 or stay at 50. There's support from data, depending on what you look at. If you want to go to the 25 camp, you look at the retail sales numbers, you look at the curve inversion. The 50, you look at the labor market, and there's downside risk to both. So it's a really interesting debate. I'm not sure there is the right answer. And then you have to factor in what the market is pricing, which is not what the Fed is telling us, and the credibility issue. I think if you put all that together, I would go personally for 50. And that's because I think inflation is going to get sticky in mid-year at around 4%. And I'd rather get the tightening out of the way now than when the economy weakens. But it's tough. It's a personal judgment. I'd go for 50.
You would typically break.
Another argument to make around going for 50 right now is the fact that you listen to all these Fed folks, right? And they if you kind of read the tea tree leaves, it sounds like they're talking about 2 25 basis point moves, right? And why not just go 50? Like, just get it out of the way. Let's go 50. Let's get it done. And then you can kind of wait a little while and see what happens. Why play this game of now a 25 and then we'll wait a month or two and then we'll do another 25? Like just go 50. Yeah, it's clear as day they still really want to do another 50 basis points. So just get it out of the way. Let's just do it. Let's just do it. Get it out of the way. The problem now is about 94 to 95% of folks on Wall Street are now expecting the Fed to do 25 basis points this upcoming rate hike. So now if the Fed does 50 basis points, guess what's going to happen? Because now everybody on Wall Street, almost every single person on Wall Street is now expecting 25 basis points. So now we're in a situation, but at the same time, as somebody that's a buyer out there in the market and a long-term investor, like I'd rather them do 50 basis points. I think it's a better decision. And on top of that, I'd rather get stocks for cheaper. And we know the market would absolutely flip out and freak out if they went 50 basis points here.
Down as pace versus destination. So this is about pace. Does the pace tell you anything about the ultimate destination?
It doesn't. The ultimate destination itself is a variable. The real question is, do you want to link the pace to the destination, where some people are tempted to do that? Say, go slower, but go for longer. I don't think that's a good idea. I think that if you look at the two-sided width of that approach, I think it tilts too much on the downside.
I always love hearing Mohammed's kind of opinion, especially on macroeconomic issues. I think he's, one of the better ones to kind of listen to on his opinion on this. And if a man like that is saying, move 50 basis points, I'm with him. Move 50 basis points, get it done. Why go 25 and then just to do another 25 later and just get it out of the way, get it done. They want to go 50 at the end of the day, get it done, and then wait a while, see what happens, and then you can kind of make your move from there. If inflation continues to be a problem, then they're going to have to continue to raise rates. And if it's not, and the economy starts to fall to pieces, then you're not still in a situation where you still want to raise interest rates. You've got it done at that point in time, okay? And like I said, when it comes to Fed, I think they're going to mess up on both sides. They went way too far on one side, obviously way too easy for way too long. They'll have rates too high for too long in this situation. It'll devastate the economy, and then they're going to have to obviously flood the market out there with money again. They'll have to cut rates, and it's kind of this whole show back and forth, right? They're still hoping for a soft landing, but the more and more data we're getting around the economy, the more and more it's starting to look, keyword is starting to look, like we're getting a hardish landing. Next video up here, Fed rate cut in 2023, unlikely, says Instagram Markets. I'm just kidding, okay? It's not Instagram Markets. It's a firm or whatever you want to call them, called IG Markets Ltd. Let's get a listen to that.
A few more times this year.
The monetary policy still has more work to do.
I currently favor a 25 basis point increase at the FOMC's next meeting.
Hikes of 25 basis points will be appropriate going forward.
I expect to continue tightening policy past this meeting.
The Fed is going to have to maintain rates at high enough levels.
Policy is going to need to remain sufficiently restrictive for some time.
Now, at some point this year, I expect that the policy rate will be restrictive enough that we will hold rates in place, just hold them in place to let monetary policy do its work.
We can, and if necessary, should adjust our overall policy strategy to keep financial conditions restrictive, even as the pace slows.
Recent comment.
What did all that tell you right there? I'll tell you exactly what that told you. They're going to keep raising rates, and they're going to keep rates high. That's the bottom line for at least this year. That is basically what the Fed's telling us. Now, that might not be true. We know the Fed's backtracked many times. You remember, they thought obviously inflation was transitory, and it wasn't obviously transitory. So it doesn't mean they can't change their mind, but it's clear as day. They're basically saying rates are going higher, and they're going to stay up here for at least this year, if not for past this year. That's what they're telling us as of right now.
From Fed officials on the outlook for rate hikes. Well, our next guest says a Fed rate cut in 2023 is unlikely. Let's bring in IG market analyst Hebe Chen. Hebe, thanks for joining us. We heard those Fed speakers. They're fairly unambiguous, really, when it comes to the path of rates in 2023. But we see some interesting price action on equities markets in particular. We had a little mini rally in all the major US indexes on Friday afternoon. So is the market correctly pricing in this Fed rhetoric, or is it all more... By
the way, just so everybody knows, this is actually just from a few hours ago, essentially. Obviously, if you're going to watch this video as soon as it's released, essentially, in China, it's already daytime there. They're already onto their Monday now at this point in time.
Optimism than realism at the moment.
Well, my view is that I think the market definitely kind of showing a strong appetite for a bull market, either from the fact that they are projecting a rate cut by the end of this year, or in terms of like a bit biased view that just focus on the positive view rather than underplay or downplaying the fundamental shortcomings. Let's take the Netflix for one of a typical example. We're seeing the Netflix share price dropping up about 8% because the shareholders are celebrating for like an actual better than expected subscription number, while they kind of purposely downplaying the fact that the ending is actually one of the weakest in company's history. It's only 1/3 to the projection number. So for me, I think it looks like there's a bit of a cautious sign that the strong appetite for bull market has kind of shaping the market's view to taking into more of taking the bad news as good news, while the good news still good news. And coming back to the Fed's rate.
Before she gets in the Fed here, first off, she's trying to make this point around Netflix, and my personal opinion about what she was just talking about there. Completely don't even bother to waste your time on trying to figure out that Netflix move in regards to people being excited about a bull market or anything like that. At the end of the day, Netflix is an extremely simple stock, one of the most simple stocks I've ever seen in the market. They report bad subscriber numbers, the stock price moves down. They tear it up on subscriber numbers, the stock moves up huge. What did they do? They beat subscriber estimates by several million subscribers, not several 100,000, several million. And so despite that stock being up almost 100% from the lows into earnings, it almost doubled up, right? And then it obviously is more than a double up now. At the end of the day, they came in with that 6 subscriber number. And that's always the biggest factor in Netflix stock. So don't derive too much into that. And I think that's a false thing that a lot of folks in the market do many times, is they try to extrapolate these things and say, well, Netflix moved up huge, so investors think we're in some new bull cycle. No, Netflix just beat by several million. And it's still a stock that's down, 50% from highs roughly? So a very, very simple story there. Don't take too much from that stock. That's all I'll say about that. That baby moves when it wants to move based upon subscriber numbers. No different than if you're trying to extrapolate any move from Tesla stock. Don't do that, man. Is Tesla stock going to do its own thing regardless of the market? It'll tank. If the market's doing okay, it'll go up a ton. If the market's doing bad, Tesla can do its own thing. I've seen it time and time again.
Which I'm expecting there will be something happening by the end of this year, but I think it's probably too early to call a rate cut, because on the hands of the Fed, they have more cards to play. They could potentially keep it unchanged until that we're seeing kind of material sign of inflation to cooling down. And at this time of year, I think for the inflation-wise, there's more factors hasn't been yet to price in. We already see some easing sign, that's right, but towards the mid-year, we're seeing that China's opening will push up the demand and push up the inflation. We're seeing that Japan is coming to have a quiet inflation rate, and also the weaker USD dollar as well. They are the uncertainty that will be underpin the Fed's decisions to declare the first rate cut.
Mm-hmm. I want to return to your thoughts on China in just a moment, but in terms of the US, I mean, we have seen the S&P fall below its 200-day moving average. Do you feel that there is a risk we could test 50 days?
Well, yeah, definitely. As I said, if you're looking for the past 3 weeks' time, the S&P 500 has been up about 4%. And that is a level that we often see for the bull market and doesn't necessarily match what we have been projecting and what is the fundamental picture that we prepare for.
To be fair, it's also something you see in bear market rallies many times.
23. So for that, again, I think back to my point, I think the market is trying to downplay the fundamental shortcoming for the early early days of the 2023. There's a bit of the over optimistic there. So again, I think it's quite possible that we'll see kind of retest, and the optimism will come into a real test when we're seeing more economy fundamental pictures that has surfaced.
So that I do agree with her on. I think the market is a little too optimistic here early on in the year. We got to get through these earnings. We've got big dogs to get through. This week's a bunch of big dogs. You got Microsoft and Tesla and many others, right? Next week you're going to have, if I recall, Apple, Amazon, some of those big dogs, Meta. So, Google, McDougal. We've got to get through these earnings. If these earnings come in bad for these big dogs, and the guidance is weak, and management teams don't sound very confident, and they sound very scared, we're going to move down big on the market. We'll move down 5-10% in the S&P 500 quickly, not like over 2 months. I'm talking over like 2 weeks, 5 to 10% down, if that's the situation, right? And so I think it would be a good time for folks to just maybe kind of chill a little bit. Not get too in this super bearish mindset or super bullish mindset right now. Let's see what these earnings are like. Let's see the guidance. Let's hear from the management teams of the biggest companies in the world. And then we're going to get some context about, is the economy starting to fall apart? Or earnings of companies starting to fall apart? Or are we in a situation where it's all going to be fine? Maybe we're going to get this soft landing and it's all good, right? But we don't know for sure yet. Either way, we've got to wait for these earnings, right? These earnings are going to be absolutely massive, and these are the biggest earnings of the entire year, because not only are you getting the Q4, which is usually many companies' biggest quarter, but you're also getting guidance from companies for 2023, and that's important. I think a lot of these companies are going to back out of giving guidance for 2023. They're going to use one excuse or another, because I think a lot of them just aren't going to be able to forecast their business properly, and that's unfortunate. But nonetheless, don't get too hyped or down right now. We'll see. I tell you, in 14 trading days from now, you're going to have all the intel in the world. All the intel in the world.
Mm-hmm. Of course, there is a lot of enthusiasm around the China reopening, the bumps in the road of getting out of COVID zero policy notwithstanding. But is that reopening trade starting to look a little tired to you?
Well, first of all, I agree with that. The China's reopening is definitely one of the major positive catalysts for 2023. But what I'm a bit cautious about is that what I see the market's price action now, as you touched on before, that the China's index, China's stock is jumping about 50% in 3 months' time. From my view, I think there's a bit of the overdue and there's a bit of the overpriced in and optimistic about what the recovery could do.
Yeah, and I don't know if you guys have seen stocks like Wynn Resorts, which is a stock I personally own in my dividend account. The stock's up like 50% in the past few months. Alibaba, which is a stock I used to own back in the day, that stock, I was looking at it the other day, and it's up 65% just in the past few months, 65%. So a lot of the China-related plays are booming right now on this optimism of China actually opening back up for real, and not closing back down, not limiting again, like for real being back open. So we'll see, but man, it is a lot of optimism, and a lot of those stocks are pricing in a lot of whatever good news comes. They're pricing in a lot of that now, and I think that's something to keep in mind there.
While that we know China has been struggling, is still struggling with probably one of the worst exit waves. And putting aside that, if we turning back the clock back into 2019, if someone telling you that China's economy going to grow at 4% and population will stop growing, that you're probably not that positive, but that's what happened in the market now. And one last factor, which I'm also always cautious about, is that the major issues for China's economy, the property crisis, the credit crisis, the manufacturing crisis, they're all not the issues can be easily fixed by the reopening. So I'm positive for the China's reopening, but I just think the market's moved a bit far away to advance at this stage.
I appreciate her perspective in a massive, massive way. Really appreciated her perspective. I think that's just very fair and balanced. I like that.
And how about commodities that trade around the China reopening? How are they looking to you at the moment in terms of price action?
Well, I'm mostly bull on the gold price because that we can see the gold price is coming to the highest level in 8 months and 9 months time and surpassed the 1900, and that is being primarily boosted by the supply and the demand mechanic, especially we're seeing that, for example, the PBOC, the People's Bank of China, has been increased their gold reserve for the fourth quarter times. And plus, apart from China, we're seeing the other central banks are globally wise that we're seeing that has been coming to the level that we haven't seen since 1960s. So there's a kind of happening along with a weaker USD dollars, the central banks trying to play down the US dollars while they increase their appetite for the precious gold. So if that we are expecting the US dollar will continue to weakening towards the end of this year, of course we can expect more of the demand for the gold price.
Yeah, and she makes a good point, and I'm certainly not somebody that owns gold. I do own some silver. For full disclosure, I'm not somebody that owns gold. But yeah, I mean, if the dollar continues to weaken, that could obviously be fairly bullish for gold overall. And, dollar weakening, I think, is going to be very realistic. And a big reason why the dollar weakening matters in a significant way for folks watching this video is way beyond gold. The biggest factor on the dollar weakening, and this could be another part of the market optimism and momentum right now, the dollar weakening helps out a lot of companies that are based in the United States and do business internationally. Many companies have had their earnings kind of wrecked over this past year that are United States-based companies and do business internationally because the dollar's been overwhelmingly strong, like ridiculous. And it's hurt a lot of companies' EPSs. If the dollar continues to weaken, it will turn from basically a headwind for these companies to a tailwind for these companies. It'll actually start to help their earnings, which if it helps their earnings, that's massive for the market, right? Because then S&P, obviously, earnings could be helped up in a substantial way. And in a time period when they might need to be helped up, to be quite frank. So that might be the biggest blessing in disguise that no one ever saw coming, is in 2022 when a lot of these companies still had strong earnings, they had this headwind of FX moving against them to when they need a tailwind behind them and they need something positive. They might actually have something positive, which is a dollar weakening. But you can't get too excited about these things. We got a lot to play out here. It's an evolving story. I'm going to keep you guys up to date with everything going on. Appreciate every single person that subscribed to the channel. Thank you so much. Also, thank you everybody that supports the channel on Patreon. If you haven't joined us in there, what the heck are you doing? We got one of the fastest growing Patreons out there. That is pinned comment down there. Much love. Appreciate everybody and have a great day.